Before we can discuss how to compile financial information, let's first briefly discuss the reason why we do it. And that reason is to help users make decisions. Before we talk about the two different types of users, let's first look at the definition of accounting. Accounting is the information system that identifies, records, and communicates the economic events of an organization to interested users. So essentially with financial accounting, we are taking all these economic events that an organization engages in, and we are communicating those events in a usable form to help users make very important decisions about the company. Now there are two different types of users. The first type is going to be our internal users. These are obviously people that are internal to the company, primarily our managers, and these are the guys and girls that run the day-to-day operations of the business. And they obviously make very important decisions about the company, and those decisions often are impacted by financial information. For example, a manager may use financial information to help to determine the appropriate price of a product. They may also look at the financial information to determine whether or not their department was successful in a prior period, and maybe what expenses could be cut to help it be more successful in the future, that sort of thing. Now the second type of user are external users. Obviously these are people outside of the company. The first example is investors or owners of the organization. And these are people that are going to use financial information to make decisions about the stock of a company. The second example of an external user are creditors. Another name for creditor is debtor. It's essentially someone that a company owes money to. And they will obviously use financial information to assess the risk of a particular organization, the risk of loaning that organization money. For example, if a company goes to a bank and asks for a loan, one of the first things that loan officer should do is look at the financial statements of that company to determine whether or not they should loan the money to that organization. Now there are various other external users, and I list some examples here. For example, the State Tax Commission, they will look at the financial information to determine whether or not the company is paying the sales tax that they should pay. So there are multiple examples of external users. Okay, so the next thing we need to talk about is communicating with users. I said that the reason why we have financial accounting is to communicate with users, is to help them make decisions. And so how do we communicate with users? Well, the primary means of communicating with users, and the one that we will focus on, are financial statements. And like I note here, that is the backbone of financial accounting. It's really what financial accounting centers around, our financial statements. Now there are 4 financial statements, and they have to be prepared in this order. That's super important for you to remember right now. You have to prepare these financial statements in this order. The first one that you must prepare is the income statement. The income statement will report the revenues and the expenses for the period, and it indicates how successful a business was during a particular period. Now the second statement that we must prepare is the retained earnings statement, and this basically indicates how previous income was used essentially. Was it paid out to owners as dividends, or was it retained in the company for future growth? The third financial statement that we must prepare is the balance sheet, and this is going to essentially report what the company owns, and that's its assets, and what it owes, its liabilities at a point in time. And the fourth financial statement is the statement of cash flows, but as I indicated in your notes in your syllabus, we will not cover the statement of cash flows. So our focus are the first 3 financial statements. So let's talk about the income statement more in depth. The income statement must be prepared first. That's super important. You have to start with the income statement. And this is going to report the results of operations for a period of time. And that period of time is indicated in the title section. So what this means is that if it's, for example, for the month ended October 31st, 2014, this income statement will report the revenues and the expenses for the month of October. So all of the revenues that we earned and the expenses that we incurred during the month of October. Not before, not after, just the month of October. Now, as far as the format goes, the revenues are listed first, and then the expenses are listed. We subtract the two, and if revenues are greater, then we have a net income. If revenues are less, then we have a net loss. Now, the reason this is even important is because prior information is helpful in predicting the future. So, if a company was successful in a prior period, then that may indicate that they will be successful in a future period. Obviously, it's not a 100% guarantee, but it will give you some indication that they will be successful in a future period. Now, and on the flip side of that, if they were not successful, if they had a net loss, then that may be indicative of not being successful in the future. So again, the reason we're looking at past information is because it helps us to predict what will happen in the future. So let's look at an example. Okay, so this is an example of an income statement. In this chapter, we go through an example, the Sierra Corporation. This is a company that began operation in October, and they provide guide services, tour guide services essentially. And so let's again first look at their income statement. Now, one thing that you need to note is the title section. Every financial statement has a title section. The first line of the title section is always the company name. And then you have the financial statement name, which in this case is the income statement, and then you have the time period. And for this situation, this example, it's for the month ended October 31st, 2014. So again, this is reporting the revenues for the month of October and the expenses for the month of October, not before, not after. Like I said, you list your revenues first. You will have a little subtitle, revenues, and then any revenue you have, you list. In this case, we only have one. We have service revenue of $10,600. And then you list your expenses. You have a subtitle, expenses, and then you list all your expenses. And then you calculate your total expenses of $7,740. Your last step is to subtract your expenses from your revenue, and that gives you a net income of $2,860. And so Sierra Corporation was pretty successful, especially considering this is their first month of operations. They did have a net income. Now, a couple of things I do indicate in your notes, and this will make more sense as we go throughout the chapter. Amounts received by the company from investors are not revenue to the company. Okay, so if we get money from an investor, that is not revenue to the company. Okay, that goes in the equity section of the balance sheet, which we will discuss later. Amounts paid to investors as dividends are not expenses. Whenever we make payments to our investors, this is not considered an expense. It goes directly on the retained earnings statement, which we'll talk about in just a minute. The next financial statement that we need to learn about is the retained earnings statement. The retained earnings statement must be prepared second, obviously after the income statement. So essentially, as I mentioned before, if a company is profitable, if they have a net income, then they can either choose to pay that net income out to stockholders as dividends, or they can choose to retain it in the company for future growth. Essentially, the amount that was retained in the company is our retained earnings. Now, the retained earnings statement has the same period as the income statement. And what's really great about the retained earnings statement is it's essentially a formula. And once you learn the formula, the retained earnings statement is super simple. You always start with beginning retained earnings, and that's obviously your ending retained earnings from the prior period. You add your net income, and that comes from your income statement. So this is why the income statement must be prepared first, so we know what our net income is. After you add your net income, you would subtract your dividends. Again, those are payments to our stockholders. And that gives us ending retained earnings. If you know that formula, the retained earnings statement is super simple. The only way this can change is if the company had a net loss, then obviously you would subtract the net loss rather than adding it. So let's look at an example. Again, this is going to be Sierra Corporation. So this is their retained earnings statement. So again, we have our title section, the company name, Sierra Corporation, the retained earnings statement, and then for the month ended October 31st, 2014. So again, the time period is the same as that of the income statement. So you start with your beginning retained earnings, and that will be for the first day of the period. In this situation, this example, the period is October, so the beginning would be October 1st. Now in this case, the beginning retained earnings is 0, and the reason it is 0 is because this is the first month of operations. So normally your beginning would not be 0. Again, it's only 0 because this is the first month of operations. You then add your net income, and again we calculated net income on the income statement of $2,860 or $2,860. You do a little subtotal, and then you subtract your dividends. 500, and that gives you your ending retained earnings of 2,360. It is important that you write the word add and you write the word less. The balance sheet must be prepared third. It must be prepared after the retained earnings statement. And what the balance sheet does is it reports assets, which again are things that the company owns, and claims to assets at a point in time. So the time period for the balance sheet is very different than the time period for the income statement and the retained earnings statement. Again, the time period for the income statement and retained earnings statement are for a period of time. The balance sheet is at a point in time. It's essentially a snapshot. So it's basically saying these are the assets that we had and the claims to assets that we had on this particular day. Now there are two categories of claims to assets, which is going to be our second major section of the balance sheet. We have claims of creditors. These are called liabilities. And then we also have claims of owners. This is going to be our stockholders' equity section. Now the relationship between the categories in the balance sheet, our assets, our liabilities, and our stockholders' equity, is illustrated in the basic accounting equation. You must know the basic accounting equation. It's very important. The basic accounting equation is assets equals liabilities plus stockholders' equity. The asset side must balance with the claims to assets side. Okay, this is obviously why the balance sheet is called the balance sheet, because the sides, the sections, must balance. You always list your assets first, then your liabilities, and then your stockholders' equity. Now there are also two categories within the stockholders' equity section. Those two categories are common stock, and this results when a company sells new shares of stock to investors. And then we have retained earnings, and this is our ending retained earnings from the retained earnings statement. Okay, so again, this is why we have to prepare the retained earnings statement first, so we will know what our ending retained earnings is to go into the stockholders' equity section. So let's look at an example. So this is the balance sheet for Sierra Corporation. Notice the title section, Sierra Corporation, which is obviously the company name, and then the name of the financial statement, that's the balance sheet, and then the day that it's prepared for, and that's October 31st, 2014. It will always be the last day of the period that is covered on the income statement and the retained earnings statement. In this case, October 31st, 2014. So these are the assets that we owned, and then the liabilities and stockholders' equity on October 31st, 2014. We have our assets section. We list all our assets, and our total assets are $21,910. And then we have our liabilities and stockholders' equity section. You start with your liabilities. You list all of your liabilities. You get total liabilities of $9,550. And then you have your stockholders' equity section, including common stock and retained earnings, which again is our ending retained earnings from our retained earnings statement. When we did our retained earnings statement, our ending retained earnings is $2,360, so we simply plug that number into the balance sheet to get total stockholders' equity of $12,360. We then add that to our total liabilities to get total liabilities and stockholders' equity of $21,910. And you should notice that our total assets of $21,910 equals or balances with our total liabilities and stockholders' equity of $21,910. So we are happy. Okay, our balance sheet balances. That's a very good thing. Now, one thing to note, when we start Chapter 2, we will have classifications and categories within the assets section and within the liability section. Okay, so right now in Chapter 1, all we are concerned about is getting our assets in the assets section and our liabilities in liability section. But in Chapter 2, we will essentially break our assets into categories and break our liabilities into categories, but we'll worry about that in Chapter 2. This concludes Part 2 of the Chapter 1 lecture series on users of financial information and financial statements. I hope you enjoyed.